Hi, I'm Russ Appel, founding principal of the Praedium Group. The Praedium Group is a 31-year-old multifamily investment manager focused here in the U.S. Affordability is a big issue in housing broadly. I think when you think of rental housing versus owned housing, we have a challenge. And I think that challenge actually is more severe in owned housing, given this recent dramatic rise in interest rates, causing new entrants to the ownership market, really feeling the squeeze. It is an issue in rental housing as well, but actually right now, the rental side of the equation is really getting a benefit because ownership is really being challenged right now from an affordability standpoint. I think affordability has been a challenge for a while. About half of all renters do face affordability challenges. Generally, people think of when people's incomes, when rents are above or at 30% of people's incomes, that affordability becomes challenged. It's something that we focused on in terms of our investments for a while. And I think that it really more and more, the marketplace is becoming more sensitive. And my sense is in certain places and at certain property types, we'll see more of a challenge in terms of the ability to grow rents due to affordability, particularly now as inflation is not just making housing less affordable, but putting more pressure on all the other expenses. So I think affordability will continue to be a challenge, and I think that actually the rental side, has seen less pressure than the ownership side in terms of increases in the lack of affordability. Well, there's lots of things that the past 2 years have this pandemic has had an impact in a lot of ways. I think what you're specifically discussing is migration patterns, and I think we had been following migration patterns for quite a while, did a whole bunch of research. We think that the pandemic did accelerate some of the patterns that were already in place. And we do believe that these are trends that are likely to continue. There will be impacts, some of the migration, due to the fact that mortgage rates have gone up so much so quickly. It'll be harder for people who own as opposed to rent to give up low interest rate mortgages and move as quickly, where they'll have to have much higher interest rate mortgages. But generally, we think those trends in terms of migration are long-term. Obviously, during the pandemic, there were a lot of changes that occurred, changes in operations and how properties operate. You saw a big boost in rental rates in 2021. That is moving more towards trend as we head into the latter half of 2022 and 2023. So I think there are a lot of things that have changed. But at the end of the day, I think many of those things, as we get over and get back to more normalized, are going to sort of move back towards the trends we were on, including, by the way, migration, which was moving in the direction that we had seen some acceleration, and some of that will move back to trend, with the one exception, which is unclear to me exactly how it will impact it, which is the fact that mortgage interest rates have risen so quickly. So for some of those people that own homes that would like to move to some lower cost places, it won't be lower cost for them because they will have to give up a low interest rate mortgage. For renters, the trend continues. For business owners, a lot of that continues. So my sense is that a lot of the trends people saw accelerate during the pandemic will move back to trend as we go on, but they won't reverse. Well, there are different strategies. There are different managers. I think the most interesting thing that is hard to forecast, in some ways, is the fact that the last 10 years, sort of everybody had a good strategy. All of our track records pretty much were good over the last 10 years. And in some ways, risk management really wasn't rewarded. I think it was Warren Buffett who had an anecdote about, until the tide goes out, no one knows who's swimming naked. And I think we're at that point where we'll start to see who's swimming naked. And I think managers that who focused their strategies over the last 10 years, didn't need to have the focus on risk management because most things worked. And I think as we may be headed into a recession right now, but clearly some of the operating dynamics are changing. I think that some of those that are more focused on risk management, some of those that had experience, over longer periods of time through market cycles, and had incorporated those learnings into their investment programs, are going to really show a difference. And so I do believe that how people had capitalized their investments, how they've thought about their investments, how they had put a risk management program in place, will start differentiating managers. As we look forward, clearly the Fed has told us that they will continue to raise rates on a rapid path and are likely to hold them there. I believe that that will impact demand broadly in the economy, including demand for all products, including housing. Now, the nice thing about housing is it's kind of a service that's essential. People need a place to live. That doesn't mean people can't double up. They can't move in with parents. They can't, clearly things impact demand, but generally people need a place to live. And I think that the rental housing market has some level of protection because affordability on the ownership side has become so severely impacted with this very rapid rise in interest rates. So as we look forward, there will be more differentiation. There will be more stresses in different parts of the market. I think, in terms of valuation, everything had gotten democratized. It felt last year that cap rates were similar for higher quality, lower quality properties where there was more supply coming into the market, less supply coming into the market. I think there'll be more differentiation in performance as we look forward. We're still optimistic. Clearly, there may be a little bit of pressure in terms of valuation, given sort of this rise in interest rates, and financial assets. You often are viewed as the net present value of the future cash flows. So when that discount rate goes up, it definitely puts pressure. Right now, we're still seeing strong rental rate growth, although that is moving back towards trend. We believe. So we think that more stress will build up in the marketplace over the next year, and those that that have liquidity constraints, liquidity issues, floating rate debt, maturities will be under more stress, and so the market will become less liquid, less efficient, and I think for many of us that screams opportunity. So, we do think that rental housing, because of its interplay between ownership and because it's essential, will outperform most of the other property types. But again, we think that not all markets, not all properties will perform the same. And again, that's going to be an opportunity for those that had focused on risk going into this, and will be even more of an opportunity in terms of new investment opportunities for people, given a sort of less efficient marketplace.